Hello everyone, in this presentation, we will present our thesis titled The Role of Family Firms in ESG Score and Corporate Performance, Evidence from Taiwan. This is our table of contents. Sustainability has become a major priority worldwide as we face climate change, global warming, and rising social inequality. These challenges have pushed companies to operate more responsibly, and ESG has become a key framework to evaluate long-term corporate behavior. At the same time, another important force shaping corporate behavior is family ownership. Family firms are especially important in Asia. Global data shows that the world's largest family businesses generate trillions in revenue, and their influence is even stronger in Asian markets with high ownership concentration. Taiwan provides a very relevant context. About 70% of listed firms are family-owned, and the government strongly promotes ESG disclosure. Because these firms play such a central role in the economy, their approach to ESG is especially important. However, when we look at family firms, previous studies do not agree on how family ownership affects ESG performance, making the expected effect becomes unclear. Family firms have both financial and non-financial goals. Socio-emotional wealth theory suggests they invest in ESG to protect their identity and reputation, while agency theory argues that concentrated family control may reduce transparency and weaken ESG investment. Because of these opposing views, the true relationship remains uncertain. This mixed evidence shows that we still do not fully understand how family ownership shapes ESG behavior and whether these ESG efforts actually translate into better financial performance. Based on these conditions, this study explores two key questions. How does family ownership influence ESG performance in Taiwan? And does family ownership strengthen or weaken the link between ESG and corporate financial performance? By combining both socio-emotional wealth and agency theory, this study hopes to provide a clearer and more understanding of ESG behavior in family-controlled companies. To explain why family firms may behave differently, we first use the socio-emotional wealth framework. SEW refers to the emotional value families gain from the business, such as reputation, identity, and control. Because these non-financial goals are important, family firms sometimes prioritize long-term legitimacy over short-term profits. With this long-term orientation and stronger concern for reputation, we expect family firms to be more committed to ESG practices compared to non-family firms. Therefore, our first hypothesis is family firms have higher ESG performance than non-family firms. Next, agency theory offers a different perspective. In family firms, where ownership and management are often unified, Type 1 conflicts are reduced. However, this can create another issue, Type 2 agency problems, where controlling families may act in ways that harm minority shareholders. This is especially common when control rights exceed cash flow rights. The larger the gap, the stronger the incentive for families to extract private benefits rather than invest in long-term ESG initiatives. Many empirical studies also find that family firms underinvest in corporate social responsibility and environmental activities when agency conflicts are high. Based on these arguments, we propose the following hypotheses: that family firms have lower ESG performance than non-family firms, and this negative effect is stronger when cash flow rights are low. Finally, we also examine whether family ownership moderates the link between ESG performance and financial performance. While many studies show a positive effect, arguing that ESG supports risk management, innovation, and long-term value, evidence remains mixed. Some research finds no difference between family and non-family firms, and others note that when governance is weak or ownership is too concentrated, ESG may fail to generate financial gains. In certain cases, family influence can even lower firm value if decisions reflect personal interests or internal conflict. Based on this, we propose two possibilities: that family firms moderate the relationship between ESG performance and corporate financial performance strongly or weakly. Now, let's move on to the data and methodology section. First, regarding our data source. All data used in this study were collected from the Taiwan Economic Journal, TEJ, and our sample focuses on publicly listed companies on both the Taiwan Stock Exchange and the Taipei Exchange over 9 years, from 2016 to 2024. After excluding financial and insurance, foreign companies, and incomplete observations, our final dataset consists of 1,804 firms with 14,866 firm-year observations and 9,340 observations classified as family firms. And with the dataset established, we then develop our regression models to address the main research questions, models 1 to 4, to estimate the relationship between family firms and ESG performance, while models 5 and 6 determine whether family ownership moderates the relationship between ESG performance and corporate financial performance. Moving on to our regression results, let's look at the primary relationship between family firms and ESG performance. We find that family firms have a highly significant negative impact on the total ESG score, indicating overall weaker ESG performance compared to non-family firms. When we break this into sub-pillars, the negative effect on the S score is only marginally significant, and the E score is not significant at all. The strongest evidence comes from the G score, which shows a large, highly statistically significant negative impact. So, how do we explain these differences? We view this through two theoretical lenses. First, through the socio-emotional wealth theory. To protect the family's reputation and image, owners avoid completely neglecting environmental and social responsibilities because these are external factors highly visible to the public. This explains why the negative effect on the E and S scores is minimal. Second, the extremely low governance score strongly supports agency theory, specifically the Type 2 agency problem. In family firms, high ownership concentration allows the controlling family to make decisions that benefit themselves while ignoring the expense of minority shareholders. They tend to resist strong governance practices because such rules limit their power and control. This poor governance is essentially what pulls down the overall ESG performance. To better understand this agency conflict, we split our sample into two groups based on the median value of cash flow rights variables, and the results are striking. In the low cash flow rights group, family firms have a negative impact across all the total ESG scores and all three pillars, E, S, and G, with high significance levels. In contrast, in the high cash flow rights group, we don't see significant negative impacts on the total score or the E and S pillars. However, the governance score remains significantly negative. To understand why the low cash flow rights group performs so poorly, we consider the core mechanism of the Type 2 agency problem. In a low cash flow rights environment, the controlling family holds a lot of power but has a relatively small financial stake in the company. This gives the family a strong motive to leverage their control to divert the expense of minority shareholders in the company into other external projects where they hold greater personal interests and focus less on growing the company as a whole through costly, long-term investments like ESG. Furthermore, the fact that governance remains weak even in the high cash flow rights group suggests a critical insight that poor governance is a fundamental issue for family firms in general, likely due to their concentrated control, issues with transparency, and potential agency conflict. It is highly possible that these deep-rooted governance weaknesses are the key factor influencing the firm's strategic decisions, which in turn drives down the E, S, and total ESG performance. Therefore, we conclude our results provide strong support for hypothesis 2, that family firms in our study generally have a negative impact and lower ESG performance. This is particularly true for firms with low cash flow rights, where severe agency problems can occur and lead to significantly worse ESG performance. Finally, we examined whether being a family firm changes the relationship between ESG and financial performance. First, our results show that ESG has a strong, positive impact on both ROA and Tobin's Q, significant at the 1% level. This confirms that better ESG performance generally leads to better profitability and market value. However, the interaction term is insignificant. The coefficients are close to zero, and the t-statistics are very low. So we conclude that, in this context, family firms do not act as a significant moderator of the relationship between ESG and financial performance. So, in conclusion, what contributions have we made in this study? After conducting this research, we provide new empirical evidence on ESG performance in Taiwanese family firms, which has been rarely studied. We also combine socio-emotional wealth theory, agency theory, and cash flow rights to better understand why family firms care about reputation but still face governance challenges that may limit their ESG efforts. Finally, our findings give practical insights for investors to identify governance risks and for policymakers to improve transparency in firms with concentrated ownership. Overall, this study highlights the importance of considering ownership structure when looking at ESG and corporate performance. This is our work distribution table. Thank you for listening.